Hey guys, this video is the first of many in a series that we're going to go back to basics with all things related to property investing. Now this specific video, we're going to talk the difference between rental yield and capital growth, how to calculate a rental yield and what the difference is between the two and why you should be paying attention to both when you are looking for your first investment property. I've got the trusty iPad here today to draw through and explain as I'm talking through this particular topic. So let's first have a look here. Now, let's just make sure we've got all things right here. So rental yield is essentially the income that you get from the property that you purchase. Now, with rental yield, there's basically going to be two types. Most commonly with residential property investing, you will see what is commonly referred to as a gross rental yield. Now, all this simply means is this is the income of the property, so the rental income before expenses. When you look at net rental yield, my writing is terrible, it is the income after expenses. So that is the difference between gross and net rental yields. Now the reason why this is important, obviously, is that when you are looking to buy your investment property, you want to know what the rental income is going to be. And this is a very quick and easy way to understand potentially the feasibility of the property that you're going to buy. So how do you calculate rental yield? Now, essentially how I would do this, and let's use an example here. So let's say we've got our property, it is worth $500,000, or we buy it for $500,000. And let's just say the rent on this property is $550 per week. So how you would calculate this is you would take the $550 per week and you would times that by 52 weeks in the year. And that is going to equal, I don't know what my maths is on that, but let's have a quick little look. See, 550 times 52 is equal to $28,600. And then you divide that by the purchase price, in which case is 500,000, and we essentially get a rental yield of 5.72%. All right, now remember, this is the gross rental yield. All right, because we don't yet know what the expenses are of the property, but this is a good indicator and a good way for you to compare properties. So if you're looking and you're comparing property A with property B, you can quickly calculate what the gross rental yield is on the purchase price, and then you can assess the feasibility of it. Now, obviously, you want to dive a little bit further into that to understand what the net rental yield is at the end of the day, but that's a good, quick and easy way to understand what the potential cash flow would look like on the property. Now, obviously, every property is going to have a different expenses and things like that, but a good way to quickly assess the feasibility. Now, when we start to look at capital growth, oops, my writing, I've got to work on that. I do apologize. Capital growth is essentially, say you've got a property here, and again, let's just use the $500,000 example. You bought the property for $500,000 and you bought an area with a long-term historical growth rate of, let's just make it the math simple here. Let's just say the growth rate is 5% per annum. So what that would mean for your $500,000 investment property, if this growth rate were to hold true, is that this property is going to increase in value in 12 months' time, essentially. The property will then be worth, you bought it at 500, next year it's worth $525,000. Now obviously this growth rate, or the historical growth rate, is really just an indication of what's happened previously. It doesn't mean to say that's going to happen in the future, but Nonetheless, this is a good way to sort of estimate where the value of the property is projected to go. Now, the reason why it's important to estimate where the value of the property is looking to go is coming back, I guess, to your overarching goal. Most people are looking to build wealth in property. Now, capital growth right here is where the wealth is built. All right. So the cool thing about this is that over time, the longer you hold this property, the further it is going to increase in value if you've bought in the right market and the demand is there. That this 500K purchase price at 5% per annum is then going to compound over every year that you own it. So we're going to get now in year 2, if this 5% growth rate holds true, it's going to be 5% on the 525,000, right? So in year 3, the property is then worth 551,000, right? So in 3 years, you've made 50 grand just by holding the property. This is why capital growth is essential for building wealth in property. Now, what's the difference between the two? Because a lot of people go, okay, well, you know, I want to have, you know, I want cash flow, so I need a good, strong rental yield. And other people go, well, no, I want capital growth, so I want a good growth rate. Now, let's have a look at the difference between the two, right? So let's just bring this example here. You've got 2 properties. They're worth $500,000 each. Now, if you were solely focused on cash flow, this property here, like we said, is going to make you, in terms of the rental income, $28,000 a year in rental income, which on the surface level sounds great, right? But most of the time, we're going to have a loan to pay back. We're going to have council rates. We're going to have a property manager. We're going to have insurance to pay, pretty much at a minimum. These are your base costs of holding the property. Now, with a property like this, just based on my experience, property like this is probably going to cost you in the region, outside of your loan, probably about $100 to $150 a week. So let's call it $150 a week. Now, if you put, say, a 20% deposit down, so 100 grand, right? You're going to have a $400,000 loan. Now, if you had a $400,000 loan at, 6.5%, and you're paying interest only on a weekly basis, that loan is going to be roughly $500 a week. So you can see already that your rental income is $550 per week, right? Now, with your rental income being $550 per week, as you can see the maths here, you're already out of pocket, right? So you've got $650 a week here costs, $550 income, so you're out of pocket $100 per week, which over the course of the year is probably close to about $5 grand a year out of pocket. All right, and that's with a 5.7% gross yield, right? And that's pretty standard for some regional locations. So if you were solely focused on cash flow, this type of investment is really not going to be one that is going to be suitable, right? But on the contrary, on the other side of the coin, we've got our capital growth here. Now, like we said, in year 1, right, property's worth 500K. Oops, I gotta really get better with this writing. In year 2, property's worth 525, and yes, these are estimates, right? Doesn't mean it's a guarantee that this is gonna happen. In year 3, 551. So essentially, the property is costing us $5 grand a year out of pocket after all expenses, and this is before tax, but we're actually making 25 grand a year. So in terms of the net position we're moving forward, we're actually ahead $20,000 a year. And this is why when we assess properties, it's essential that we're not just focused on the cash flow component. Cash flow is important, it helps us to hold the property, but the growth allows us to build our wealth. And this is why we really need to stay focused on what is the growth potential of the property, all right, over the long term. What are we expecting it to do? And again, we can never predict the future, but we can look at historical information to give us a rough indication of where it might go, because it's in these over the years where the wealth compounds over time and where we can really start to benefit from it, right? Whereas if we were solely focused on cash flow, we'd need to look at a different asset here, because this house at a 5.7% yield is actually costing us $5,000 a year. So if we were just focused on that, we would be turning away this investment and going to focus on a townhouse or a unit that might have a 6, 7, 8% yield. All right, so that is the difference between rental income and capital growth, how you calculate rental income, the difference between gross yield and net yield, and the things that you need to focus on when you are out there buying your next investment property. Hope you got some value out of that. If you did, hit the like button and subscribe to the channel. There's going to be a lot more back to basic videos that are coming out very soon. Until next time, thanks for watching. We'll catch you soon.